Okay, we have the 5 excellent speakers just in a 90-minute session, so I don't waste our time with my not important remark at the beginning, right? So, okay, let me move straight to the first speaker, who is Ulrich Winzel. Oh, I'm very sorry, my pronunciation is very wrong. He is the Director General Market Operations, ECB, right? Yep. Okay, he will talk about, he is focused on how the ECB operation works, should adjust in the future, and how monetary should be conducted with a large balance sheet. Okay, please.
Yeah.
Mike is yours.
Yeah, thank you. Thank you so much for the invitation, for the occasion to speak. And yeah, I already got excited from the first discussion.
Oh, great.
So I'm sure it will continue. So I have no slides also. Sorry for that.
Oh.
But I tried to be structured in my presentation. So I want to talk briefly about 4 things. So what we have learned, let's say, over the last 10 years and what it tells us for the future. So the first is, let's say, financial crisis management and the lender of last resort. The second is the low natural rate environment. The third one is what will be the new steady-state operational framework and the new steady-state central bank balance sheet. And finally, yeah, let's say one word on macroeconomic strategy in a low-growth environment. So starting with the lender of last resort and let's say crisis management in the narrow sense. And there, just to come back to the previous discussion, when Esther was saying that central banks were funded as lender of last resort, I had the same reaction as Athanasios, that I thought that was not true. And Athanasios, you said it's not true, they were funded for, let's say, fiscal purposes. I also thought this is also not true either, because I think the first central banks were founded in the early 17th century for payment system purposes, no? And then the other functions, I mean, the Bank of England invented, let's say, the central bank for really the main purpose of fiscal policy. But okay, lender of last resort has been a very old, let's say, central bank responsibility before the foundation of the Fed, certainly. And here, okay, all the measures that were taken in the early years of the crisis in 2007 and 2008, if we look back to them, I would say the consensus would be that the measures were generally well taken, they were forceful. There's, of course, the question, do you design all those measures in a way that they are optimal, that you are kind of on the efficient frontier in the trade-off between supportiveness and, let's say, not overdoing it, taking into account, let's say, moral hazard, taking into account the risk of zombification, or taking into account also central bank risk management concerns. Yeah. So the first question is, are you on the efficient frontier in this trade-off when you design all the details of your lender of last resort activity? And then the second question is, do you choose the right point on the trade-off? So are you too nice or are you too tough? And I mean, if we ask ourselves overall, have central banks got it right? I mean, it's a question, of course, of detail where you cannot give one single answer. And certainly some things may have been done different in retrospect. But overall, I would say the conclusion is central banks broadly got it right. Yeah, they seem to have strike the right balance and have overall, I would say, got this right. I mean, some people may say that the 2008-9 recession could have been avoided by more supportive policies, question mark. But my sense is that that's very difficult to conclude. So lender of last resort, all the activities that were done, and they were various, and I wouldn't go to the detail, but I would say were confirmed, were brought to the memories, back to the memories of central bankers and to the public. And I would say in future crises we have learned, but the next crisis will be different. We will face similar, on one side, similar challenges where we may use what we have learned in 2008, and there will be new challenges. And I would say, in principle, we will start from what was done last time, and that is, I would say, relatively simple. The next point is maybe less simple. That's, oh no, let me say one more thing. I think what we have learned is that the lender of last resort in central banks has different forms, no? And it has, in particular, I would say two forms. One is the elastic central bank credit through the normal monetary policy framework. So if one looks at central bank balance sheet, what has made them increase in 2007 and 8? I mean, taking the case of the ECB or the Euro system, it was in particular elastic central bank credit in the context of monetary policy operations as allowed by the collateral framework. No, that was the big element. So lesson for operational frameworks of monetary policies are important. Yeah. So for the future, the question how liberal, how broad should be your collateral framework? Do you want to maintain it relatively narrow in normal times and expand it in a crisis? Do you want to have it broad in normal times? That's a relevant question to look at. And here clearly the normal monetary policy framework has a very important role to play. Moving then to, let's say, the challenges that came after 2008. That's the basically low natural rate environment, and the difficulties, let's say, to re-stimulate, let's say, inflation to the levels desired by central bank. And I think it's important to get the diagnosis right of those challenges. I mean, first of all, I think the Wickselian logic is a starting point still. No, that somehow there is a kind of neutral rate that you want to achieve, or that you want to if you want to send an expansionary monetary impulse, you want to set the monetary policy rate below a kind of neutral rate, and the neutral rate is somehow the sum of inflation expectations and let's say the potential growth of the economy. And if you have a low growth economy, and if you have, let's say, super credible central banks as inflation fighters, and then if you are close to the zero lower bound perceived by markets constraining your potential to act, then you may be constrained, no? And that may, undermine further inflation expectations and make it even more difficult for you. So what do you have to do in that context? I would say you have to act quickly and forcefully. No, you should not wait. I think that was Atanasio's important point. No, act forcefully and early. And I would say act forcefully and early also because maybe your potential is not unlimited, really. You said quickly, Atanasio said, we are limited on negative interest rates, and I think that's true. But maybe we should spend a bit more time on negative interest rates nevertheless. So I would say negative interest rates were something really not, thought about beforehand. Okay, some smaller central banks used it for FX policy reasons, but ECB, let's say, innovated as a major central banks to apply it for monetary policy. And I would say the experience with negative rates is a very positive one, I would say, in terms relative to, let's say, fears that were expressed beforehand. So I think what we have learned is that you can bring down interest rates easily to minus 40 basis points. Other central banks have gone down as low as minus 75 basis points without, first of all, an explosion of banknotes. No, you have not reached the threshold of banknotes being, let's say, arbitraged. And I think that makes quite a difference. So if you can really go, let's say, to minus 75 basis points in a low growth world, this creates you quite some, I would say, extra potential. And I would say it's a potential that you can use with, in my view, very limited challenges associated to it. No, I mean, if we look at criticism of negative interest rates, let me quickly go through three of them. First one was, I mean, that financial markets maybe cannot handle them, which has two sub-variants. One is, the fear that there are, Y2K kind of issues in IT programs. But okay, that you can address with lead times, and that's how it was done, and there were no problems. You can also say there's something fundamentally, different, wrong or what with negative rates that financial markets cannot digest. But for me, I mean, I don't see this reason at all. An interest rate is a relative price between a good tomorrow and a good today. And the good tomorrow, can be more expensive or less expensive than the good today. Therefore, interest rates can be positive or negative, and economically there is nothing really special with interest rate changing sign in principle. Next point was it undermines bank profitability. So here first, it's not specific to negative rates, no? If, let's say, retail deposit rates are somehow sticky at close to zero, then already if you move rates down towards zero, policy rates, then already you undermine bank profitability. So it's not really at the moment where you have a small negative sign that something fundamentally new happens, no? It's a gradual process. And maybe the second point is that I think, of course, central banks need to take this effect into account if they model the transmission mechanism of monetary policy, no? So in a certain way, if you lower rates, you have all the positive expansionary effects, but there's a slight effect which is negative on bank profitability coming from interest rate margins, and that, of course, you have to take into account when you model your transmission mechanism, but it's certainly not an effect which is strong enough to change the sign of transmission of monetary policy. So even on bank profitability, all the estimates of the ECB at least indicate that the expansionary monetary policy has supported bank profitability. In particular, obviously, if you include growth effects and effects on NPLs, etc. And even if there would be a negative effect on bank profitability, I would say it's still not in the interest of banks even to conclude the central bank shouldn't do it, because obviously the purpose of monetary policy, of expansionary one, is to be successful and to be successful quickly. So not acting, as Atanasio says, is just a recipe for ending in a low rate environment forever, and that's not in the interest of the banks either. Undermining financial stability. So I personally don't see this point either. I mean, first is undue risk taking. Is there undue risk taking? My impression is that there's very little evidence that there is undue risk taking following from low interest rates. I mean, there's obviously the schizophrenia of, on the one side, wanting banks to take risks. I mean, if you do QE, you buy low risk assets from the market. Obviously, there have to be portfolio rebalancing effects. I mean, those from who you buy the risk-free assets, they have to go into more risky assets. That's just logical. And I would say then it's a matter of evidence. There is, in my view, very little evidence of an undue risk-taking. Second variant of financial stability concerns is on asset price bubbles that are created. And here again, I would say evidence for me is not very strong. Obviously, if asset prices increase because of low interest rates, then the other way around, if interest rates increase again, asset prices may have to fall, and that implies gradualism in exit and being careful, of course, on exit. Yeah. So I think those were the main points on negative interest rates. So I think we have learned that this is an effective tool. Coming back to bank profitability issues, I mean, the Bank of Japan, when going into negative interest rates, has addressed the excess liquidity, negative remuneration issue also with the tiering system on excess reserves, so that you can also do. So overall, I think negative rates are in the arsenal for the future. They have been proven to work well and to give, let's say, quite some extra leeway in a low growth world for the future. On QE, I think there also, I mean, the logic that was summarized by Athanasios is, I mean, I share this clearly. Central banks who do this, of course, share this. And I mean, just here the issue is of what unlimited means, no? I think there is a lot of leeway for central banks to buy assets, no? So if you act forcefully, I think there is enough leeway to be effective, in particular if you combine it with negative rates, because a combination of the two is instrumental to get long-term rates particularly low and have this expansionary impulse. I mean, unlimited still, I think there is a limit somewhere. Of course, the central bank can, you know, has in principle the theoretical threat to buy all the assets of the world. And if you buy all the assets of the world, prices must increase at some stage, no? So I think that's a relevant argument. But at some stage, of course, if you buy all the assets of the world, you probably undermine the principle of a decentralized economy, because if you own everything as a central bank, okay, you have to manage it, no? So we buy corporate bonds now. I mean, depending on how much corporate bonds you held, you get, of course, drawn into decisions, no? You cannot stay completely out. So the more you enter asset classes which are not trivial, the more, let's say, you have issues, and the more, at the end, you will centralize the economy in the central bank balance sheet, no? And again, the leeway to, before you reach this point is large, yeah? But it's not unlimited, yeah? So, I mean, which draws a conclusion for me that you have to act forcefully and quickly when it's needed, and you should combine QE with negative interest rates, because the two together are particularly powerful, yeah. Maybe I stop there. Thank you.
Thank you very much for the wonderful presentation. I'll taking the question after all the presentation. So let's move on to the next speaker. Next speaker is Gregory Kress.
Yes.
Okay. He is a research fellow here in the Bruegel, and he will discuss the inflation target and the possibility to raise the target to be able to combat the next recession. Please.
Thank you. I think I have some slides if... Yeah, they are already. Yeah. Okay. Perfect. Great. So let me first start by thanking Professor Nakamura for the introduction and for chairing that panel. Let me also thank the other participants of the panel and the speakers, because I participated to organizing it. So thank you very much for accepting our invitation. So as we discuss the future of monetary policy and how to fight, in fact, how to be ready to fight the next recession, I want to use those 10 minutes to discuss one particular option to avoid the zero lower bounds that has been plaguing us in the previous crisis, and on how to increase the policy space in the future for monetary policy. So of course, here we have already discussed many options, or we will discuss many options to do that. We have discussed QE, we just discussed a negative rate. I think Miles will also discuss that. We will discuss helicopter money with Eric. We have discussed forward guidance, etc. What I want to do is really to focus on the possibility to raise the inflation target. So basically, why would we do that? What is the problem that we try to solve, and why should we do that? I think that yeah. It's not because I work for Bruegel that it works better, apparently.
Yeah, you should.
It's 5 times, okay. 5 times. So what's the problem? The problem is that there might be a secular decline of the neutral rates that was already mentioned by the previous speaker, that is really taking place in advanced economies. Just to make a little bit of definition, because I think we all use different definitions for the neutral rate. So what I mean by the neutral rate is the equilibrium real rate, contrarily to what's your definition, where you were mentioning it's also including inflation expectation. My definition is the equilibrium real rate that is compatible with price stability and, yeah, sorry. Okay. that is compatible, so the equilibrium real rate compatible with price stability and full employment of capital and labor. So that's the way we define it. So given that definition, it's thus a very precious guide for monetary policy. Unfortunately, however, it's not observable, so we need to estimate it. So what I'm showing in that picture here that you can see is an estimate made by 3 researchers from the Fed, Alston, Lobach, and Williams, that did that in 2016 and that have updated it since. And what basically you can see in that picture is that we observe a downward trend since the beginning of the time period, since the 60s. And the most important point, I think, is that we also observe a major fall with the global financial crisis in 2008. So basically, overall, what we see is that it went from 3, 4, 5% at the beginning of the 60s to today somewhere between 0 and 1% for the Fed and for the euro area. So that's for the US and the euro area. So I'm not going to focus on the main drivers of this fall. I think it's a very interesting conversation about secular stagnation and what are the potential drivers behind secular stagnation. It can be demographics, it can be global imbalances, global self-in glut, inequality, lack of profitable investment. There are many reasons behind it, but I don't think that's the main topic of today. So I will just take this fall in neutral rate as a given, and then I will focus on the harmful consequences that this can have for the conduct of monetary policy. So what are the consequences for monetary policy? There are 2 main consequences for monetary policy. The first one is that the steady state nominal level of short-term policy rate, so which again is defined as the neutral rate, so this real rate, plus the inflation target, is going to be much lower than it was before. In fact, what you can see on the left-hand side panel is that it seems that the members of the FOMC are already starting buying into this story of secular stagnation, because the median prediction for their policy rate at a long-term horizon fell from 4.25% in 2012, when they started publishing those numbers, to 2.75% today. And this is pretty much compatible with the estimation made by the Fed researchers, because 2.75% is basically 0.75% neutral rate and 2% inflation target. So it seems that the members of the Fed are really believing this secular stagnation story. What is the second consequence? In fact, it's a consequence from that. Is the fact that if you have a lower neutral rate, it means that the central bank will have less space to cut rates when there is a shock and when there is a deviation from the inflation target or full employment. And basically, they will have less space to cut their main tool, which is the policy rate. And here I give the example of a simple Taylor rule for the ECB using 2 different specifications. The first one is using the usual neutral rate that was in the specification of Taylor when he wrote the first paper about Taylor rules, which was R star equal to 2%. And I take another specification where I replace those 2%, those fixed 2%, by a time-varying neutral rate, and I take here the estimation made by the Fed researchers for the euro area. And so the red one, so the black line is what the ECB did with his main refinancing operation. The red line is the one with the time invariant R star, and the blue line is the version with time varying neutral rate. And basically, what you can see here is that it brings 2 different results, because with the fall of the neutral rate, the Taylor rule suggests that we have negative rates. So one possibility, of course, that will be discussed later, is to have really negative rates, or even lower than the ones that we had in Europe. But the other possibility is that we cut interest rate to 0, and then we use QE in order to compensate for the difference between the 0 lower bound and what should be necessary to fulfill the mandate of the ECB and bring back inflation to 2%. So, and if you want an historical perspective of the policy rate and the slowdown since the 1950s, I did that for the US, the UK, Germany, and Japan. And basically what you see here, so the gray bars are the slowdowns. They are a bit different for the US and for the other country, because for the US it's the NBER recessions, while for the other countries it's slowdowns dated by the OECD, so it's a bit different. But what you can see is that on average, when you have this slowdown and when you have these recessions, you need to cut interest rate by a lot. In the US, the policy rate has been cut on average by 500 basis points since the beginning of the 50s to provide monetary policy accommodation. While for Germany, the UK and Japan, and here Germany I take the Bundesbank before and then the ECB, we had policy accommodation of around a bit more than 300 basis points for the previous slowdown since the 1950s. So a lot of accommodation, 500 basis points for the US, 300 approximately for the other jurisdiction. So that's a lot of policy accommodation. The thing is that with a lower neutral rate and lower steady state nominal policy rate, we won't be able to provide this type of monetary policy accommodation in the future. So if there is a recession now, it will be much more difficult. And for example, it will not be able, the Fed will not be able to provide 500 basis points if its steady state nominal short-term rate is 2.75, as FOMC believes. And so basically, we will be constrained by the zero lower bound more often in the future and for a longer period of time. So that could be a problem for monetary policy. So basically, the raising the inflation target is one of the options to deal with that problem. And we can take a look at the pros and cons. I have to say I'm still a bit agnostic about this when I wrote this presentation. I really wanted to put all the pros and cons, and I will let you decide if you think that the pros are better than the cons or the opposite. It will depend also maybe on your preferences. So basically, what are the pros of raising the inflation target? The first obvious advantage is that you will avoid falling to the zero lower bound in the first place. Of course, if you increase the target from 2 to 4%, for instance, the steady state nominal rate will be higher. It will be taking a neutral rate of, let's say, 1%. It will be at 5%, and it will leave ample space, for example, in the euro area, to cut rates by 300 basis points, as we did in the previous slowdown and recession. So that's the first thing. The second thing that is linked also is that the market will be able to clear at a lower real rate. If you cut to zero with a 4% inflation expectation, you will have real rate equal to -4%, which is much bigger than we have today. So that give those two things give much more policy space. So that's the good thing. But I would say that something that is quite important, and also it's important considering the discussions that we have seen before about the uncertainty concerning unconventional monetary policy, is that basically what raising the inflation target will allow is that it will allow us to rely much less on this kind of policies. Basically, we have seen that QE effects are much more uncertain. It was mentioned by several participants before. It's also more difficult to calibrate, as Professor Arfanides mentioned, even though his idea is that we should calibrate by trying. But it's also much more difficult to calibrate than just cutting interest rate, because we have been doing that for decades. So that's already something that is better than doing QE. And I would say that a good reason maybe to raise the inflation target in the Eurozone is that QE, given that we have 19 treasuries inside the Eurozone, is much more politically controversial for reasons that were mentioned by Ulrich before, for the moral hazard problem, given that we have 19 different treasury bonds to buy. It's much more politically controversial. And that's a bit of a problem, and that was a problem of the previous crisis, because this led to some delays in implementation of QE, as was mentioned by Professor Arfanides. We waited 6 more years than the UK and the US to start QE. And the problem is that if the neutral rate really stay lower and around zero for a long period of time, in that case, the main policy tool of the ECB will be QE. And if QE is controversial, we could always have this discussion of should we do QE, should we not do QE, how much should we do QE, and it could lead to a permanent suboptimal policy. So I think that's a bit of a problem that could be solved with a higher inflation target. target. The same works with negative rates. In the end, as I said before, the negative rates are a bit of a substitute they are a substitute to a higher inflation target, because basically they also increase the policy space. And they also allow to have lower real rates in the first place. The difference with negative rates is that first, they are also constrained by the fact that there exists cash, so people can switch to cash if rates are very negative. And we don't have example where negative rates have been below -1%. So here we could increase the target by 2%, so it's already twice what we could do with negative rates. And also, as were mentioned before, and also by Ulrich, there might be some potential side effect of this unconventional monetary policy, QE and negative rates, both on financial stability and on inequality. So that's something that you would not have maybe with raising the inflation target. So. And other pros is that also the cost of higher inflation is smaller than we thought before. In fact, there was a very interesting paper by Nakamura and co-authors that was published a few months ago, showing that they look at the period of high inflation in the US in the 70s and 80s, and they show that in the end, the distortion coming from higher inflation was not that big, and not as big as we thought at the time, because in fact, there was no real change between relative prices. That's what we were afraid of, that basically relative prices would be distorted. And in fact, they show that there was not much distortion at that period. So basically, having 2 or 4% inflation is not that distortive. Even their conclusion is that even having like 8 to 10 inflation is not that distortive. And finally, I think, and it's a problem of transition, is that raising the inflation target today will result in a windfall for debtors, because the debt are fixed, are in fixed term generally, and it will help solve the current debt overhang. So that could be very useful today. Let me just, if I have a bit more time, look at the con side, because I don't want to seem biased. Basically, the people who argue against that say that the higher target could damage the credibility of central bank, that basically changing often the target could be a problem of credibility. It could also disanchor expectation permanently. So 2% might be okay, because it's almost like people behaving as if there is no inflation. But if you have more than 2%, if you go, for example, from 2 to 4%, you could revive indexation of contracts. And that's something that has pretty much disappeared today. So that's a good thing, because when you don't have indexation of contracts, you don't have second round effects. With 4%, maybe people will behave in a different way. They will think that there is a bit of inflation, and they will ask from their company to index their wages. And in that case, if we have like a shock, for example, an oil shock, then we will have second round effects that we don't see today. So that could be a bit of a problem. The other thing that could be a problem, but it's a bit the opposite problem, is maybe the change in expectation could be very slow also. So it's not because the ECB says that we go from 2 to 4 that people will change their expectation immediately. In fact, what we have seen in Japan is that expectations take a lot of time to change. And so if they don't change, in that case, you don't have the benefit from changing the target. Finally, and I think something that I think is much more important and much more fundamental, is that maybe it will be a permanent or a long-lasting change for what might be only a temporary problem. In the end, there is a lot of uncertainty around this neutral rate estimates. Yeah. There is a lot of uncertainty around the neutral rate estimate, and basically changing our whole monetary policy framework because we have made those estimates could be dangerous. So maybe we should wait a bit more before making that change. And finally, the transition is that another transition problem. Before I had a transition that was positive. Now for the transition something negative is that it could hurt holders of bonds and non-index assets, and there could be some financial stability risk. So these were basically my pros and cons. Just to conclude, as I have said, I'm still a bit agnostic about it. I will not stick my neck. I will just say that more research is needed, as usual. But I think we should not dismiss the idea in principle. The risks seem, in my view, a bit overemphasized. And there are experiences, in fact, of changes around the world. Canada is reviewing its target every 5 years. The UK, the target, in fact, is fixed every year, even though it doesn't change much. But it has been revised once in 2003. So Japan, the BOJ changed its target in 2012 to 1%, and then in 2013 to 2%. The US only adopted a formal target in 2012. So I would say let's not be ideological about this, and basically in the Eurozone the target is not set in stone, it's defined by the ECB itself. So maybe it's time to reassess if the target is still suitable, if the neutral rate has fallen. And maybe we could have something like an audit of the strategy, like the ones that we had in 2003, during which we already clarified the definition of price stability, and during which we changed the two-pillar strategy. So at least there could be like a, let's say, it's, something very logical at the end of a presentation. We should create a commission to review the target of the ECB or something like this. Okay, thank you very much for your time.
Okay, thank you very much. Let's move to the third speaker. Third speaker is Miles Kimball. He is a professor of economics, University of Colorado Boulder. He will focus on the negative interest rate and how to eliminate the zero lower bound. As you know, he was a strong advocate of that policy during the crisis. Please.
Thank you. So while they're getting my slides up, it's...
Michael, please, Mike.
Oh, okay. Let me see if, I hope I can make this work.
Great.
Good. All right. So actually, let me say a few general things related to what's been said already. This conference is called Monetary Policy in an Age of Uncertainty. And we have uncertainty about the long-run natural interest rate, the dependability of the inflation determination equations, like the Phillips curve, movements in risk premia. And I want to talk about an approach that makes it so that we can get the monetary policy job done despite all of that uncertainty. And it has to do with the fact that negative rates are not at all limited in their potential, and there isn't a limitation on the space that we have there. For example, because it's established by treaty with broad powers, if necessary, the ECB is in a strong legal position to use much deeper negative rates than it did, in fact. And in relation to the inflation target, the benefits of eliminating the zero lower bound are similar to raising the inflation target, but without the costs that you mentioned. And the approach I'm going to talk about leaves a normal yield curve, which should help with financial stability, and also knowing that you have all the aggregate demand that you need. There's no longer any scarcity of aggregate demand takes away a big argument against the high capital requirements that are the best way to enhance financial stability. So here's the message. With readily available tools, there's no effective lower bound on rates. First of all, the paper currency problem can be readily handled either cleanly using a price mechanism or messily using a combination of price and quantity measures. Second, the bank profits problem can be readily handled by transferring funds to banks when necessary, and indeed that's current policy, with Japan having its tiered interest on reserves and with the ECB doing TLTROs that lend to banks at low rates. This is already current policy to throw money to banks if you worry about the bank profits problem. That's really easy. Put 10 central bankers in a room for 3 hours, they'll think of 15 ways to transfer money to banks that are relatively invisible to the public. So I don't think the bank profits problem is insoluble. Finally, the political issue is a big one. And I know that the folks that actually sit on monetary policy committees have political antenna. And so I want to try to say some things that I hope are helpful about how to handle the political costs of low rates. First of all, you can shield small household accounts from negative rates, and I think that's a policy that should be much more studied than is with a subsidy. I'll talk about that on the next slide. And good communications are going to help. And then I'll emphasize how the costs of not doing vigorous monetary policy, the political costs are very high for not doing vigorous monetary policy. Okay, here's an example of how you can shield small household accounts from negative rates. And this is a big deal politically. If you think of where journalists want to go when you talk about negative rates, it's people having negative rates on their checking accounts and savings accounts. So suppose you did the following. There are already very complicated interest on reserve formulas for Switzerland and Japan. So this is well within the range of current policy, just an extra detail. You basically say the amount of reserves you can get zero on instead of minus 1.5% depends on how much you have in small accounts. You know, the first 2,000 euros, let's say, of every account. You add that amount up, you do voluntary reporting. That you can get 0 on in your reserve accounts. Beyond that, you get minus 2%. And I think this is something that should be studied by staffs at central banks that think they might need to use negative rates at any point. And you can easily avoid double dipping. People in the voluntary reporting, they have to say, this is my primary bank, here's my personal ID number, like a social security number. You can avoid double dipping. And there's a big debate about what the exemption amount is. I mean, in Japan, there's some people that have huge amounts of money they're saving for retirement in their checking and savings account. Unfortunately, you probably can't have an exemption amount large enough to protect all of those folks. But, you know, I can see a big debate about the exemption amounts. Now, there's several advantages here. Not only do you shield the small accounts, which is a big political benefit, and by the way, there's plenty of transmission mechanism. It's okay. You don't need this for... Yes, you give away a tiny, tiny bit of the transmission mechanism. But in addition to the political benefits, you've got benefits for bank profits. So the banks can give the 0 on the small deposits where things are probably, that's kind of a sticky, they don't want to go negative without hurting their profits because there's basically a central bank subsidy. It's also a marker for pass-through. It probably makes it easier to have negative rates on larger amounts if you say, oh, you're above the exemption amount that the central bank said. And the central bank isn't really saying that. They're saying do whatever you want in terms of deposit things, but they can blame it on that. So you probably get better pass-through. If you choose to keep a lower bound on interest rates, I want to argue it's corrosive to central bank credibility and independence. First of all, doubts that central banks have enough monetary firepower can lead markets to brush off inflation targets. You can say, let's raise the inflation target to 4%, but when you're having trouble getting up to 2%, that's not to be taken for granted. Second, long-lasting slumps and slow recoveries bring central banks under attack, and we see this a lot in the United States. I mean, we're the country that has regular chance of end the Fed every time we have a political campaign, and the fact that things were bad for so long after the financial crisis has a lot to do with that. Finally, weak stimulus from mildly low rates for a long time makes people begin to think that central banks caused the low natural rate and blame central banks for that. Anytime you get a question about, oh no, what about the pension funds? That shouldn't be in the central bank purview at all. The rates that matter for pension funds aren't under the control of the central bank, but people get confused when you have low rates, mildly low rates for a long time instead of what I'm going to advocate, which is deeply low rates for a very short time. Okay, deep negative rates can bring quick recoveries. It's a norm to go down 550 basis points in a typical recession, and we saw that slide a minute ago. When risk premia rise, you might need to go more. I actually think we should double the coefficients in the Taylor rule and move interest rates more and get there quicker. And there's no reason to think that deep negative rates can't bring quick recoveries. I mean, there is a transmission mechanism. Per basis point, there's no reason to doubt the transmission mechanism in negative territory is any less strong than it is in positive territory, assuming you've dealt with the bank profits and paper currency problem, which I'll talk about the paper currency problem in a minute. There's already a great deal of empirical experience with deeply negative real rates, and let me talk about the principle of countervailing wealth effects. People sometimes talk as if there's only one or two transmission mechanisms or it's all about banks. No, every borrower-lender relationship gives you transmission. Why? Because in every borrower-lender relationship, any wealth effect that goes one way for the lender goes the other way for the borrower, and borrowers almost always have higher marginal propensities to consume. It's having higher average propensities to consume that tends to make them borrowers, and average propensities to consume and marginal propensities to consume tend to go together. So let me give you the logic here. Lots of different borrower-lender relationships. They don't even all involve banks. Present discounted value shift is equal on both sides. Borrower MPCs are bigger than lender MPCs. There's a nice paper by Adrian Auclair, who's I think at Berkeley now. And then the substitution effect is just a bonus. Basically, the borrowers, when the rates go down, the borrowers are going to do more extra spending than any reduction in the spending because of the wealth effect on the lender, and then the substitution effect is just a bonus. Now, just to remind you of how many different borrower-lender relationships there are, there's all of this, plus the exchange rate effect, plus the effect of the prices of real assets going up. And let me give you an example that people often don't think about. The people lend money to the government. Okay, what's the MPC of the government? Well, for almost all governments, there may be a few exceptions. If you save money on interest payments, you're probably going to spend that money, because the way normal deficit figures are, you can say, wow, you can even still claim to be doing austerity because your deficit figures still look good. So the MPC of a government out of interest rate savings is close to 1. And this is the question that I asked Chris Sims at Jackson Hole, and he agreed with this. As long as governments are spending interest savings, you drop the interest rate and you get a lot of oomph from government spending. That's just one example here of a borrower-lender relationship. That logic goes through. Higher MPC for the borrower than the lender. You've got transmission from every borrower-lender relationship. There's no way those are all going to fail. If we eliminate the lower bound, we can bring back the great moderation. Deep negative rates can get the job done during the window of time when a central bank can resist political pressures, trying to intimidate it from vigorous action. And we can have cyclical stabilization, again, a matter of monetary policy, with fiscal policy focusing on the long run. Okay, so how do we deal with the paper currency problem? That's what I'll focus on for most of the rest of the time. I'm going to call this an electronic money policy. That's like having the electronic euro be the linchpin of the system. The paper euro is in a secondary role. The lower bound on interest rates is eliminated, ensuring unlimited monetary firepower. Now, this policy keeps paper euros in the system, but they're good for spending. They're not a little less good for saving. They're not only a little less good for saving, but you're equalizing their return with what people would get in the bank. So what do I mean by an electronic money policy? I mean a time-varying paper currency deposit fee on net cash deposits at the cash window of the central bank with electronic money as the unit of account. Let me unpack that. Number one, it's equivalent to an exchange rate at the cash window. Central banks have a power that's not talked about in money and banking textbooks, but should be, which is to determine the relative prices of different forms of money under their jurisdiction. We take this for granted that 220, that 520s equals 100, or that 210s equals a 20. That's just one of the many relative prices of different forms of money that a central bank determines. I'm not terribly interested in that. I'm interested in the exchange rate between a paper euro and a euro in the bank. I'm going to call it an electronic euro, but it's just a euro in the bank. The idea here is to be a minimum distance from the current monetary system consistent with eliminating the zero lower bound. In this clean approach, you don't need any extra regulations or quantity constraints. It works entirely through the price system. If you can have a very small dosage that shows up in a very subtle way for regular households, indeed, I think it would be very wise for central banks now to do -5 basis points, just to demonstrate that they can and are willing to do this kind of a policy. There's no way regular households will notice it. The financial press would go wild. They'd say the sky was falling, and then the sky wouldn't fall at -5 basis points, and you've already got in a stronger position with credibility. On the other hand, it's unlimited at potential dosage. You know, if you go to minus 500 basis points, people will notice that, but you only go to 500 basis points when you really need to, and then it's very helpful that you can have unlimited dosage. Now, what's the magic here? Many of you are aware of Silvio Gazelle's plan to have stamped currency, which acts on the dividend. This is not that. We're acting on the capital gains rate, and by having it's just a depreciation of paper currency relative to electronic currency. Now, I'm going to call a very tightly controlled depreciation rate on paper currency give me a little leeway on terminology. I'm going to call that a paper currency interest rate, even though it's a capital gains rate. Now, here I want to point to the screen here. Here's how it works. Here's why there's no arbitrage. So imagine an alternate history where in the US, instead of what we actually did, which was 0 rates for all these years, if the US had done -2% in 2009 and in 2010, there'd been some recovery. That's more stimulative monetary policy than we had, so let me assume some recovery here. Then we go to 0 to 2% here. If you think of dollars in a short rate account, like the reserves, $100 would turn to 98, 96, 96, 98, 100, 102. Now, let's compare that to paper currency. The idea of this policy is to equalize the rate of return on paper currency with what's happening in reserves. And so if you had a $100 bill, it would say 100 on it every year. It's physically the same bill. You don't have to physically change your bill at all. But I want to have a -2% rate of return on paper currency. When I've got -2% there, 0, 2%, 2%. And then here we kind of go back to what mostly looks like normal with paper currency at par. How do I get that negative rate of return on paper currency? I have a paper dollar that was worth 1 electronic dollar here, worth 98 electronic cents here, 96 electronic cents there, and so on. Now, this is an exchange rate that can be defended. Both types of currency can be created at will by the same central bank under the same authority. So you can certainly defend this exchange rate. And you can see the market value of that $100 bill would be the same as if you put the $100 in the reserve account. Okay. So there, and it's not like there's some way around it. There's no arbitrage here because you've equalized the rates of return. Okay, so there are many misconceptions that I could explain during the question time. Let me just say a word about this. There is a dirty approach, which some central banks have inched towards in some ways. The assumption of the paper, let me just say, in the models, paper currency says, oh, interest rate can't go negative or can't go below the storage cost. But let's think about what this means in the real world. In the real world, the U.S. has like 100% of GDP in national debt. Imagine all that national debt we're running at negative rates, maybe partly because of QE that made a lot of what was out in the public short term. That's like $15 trillion or $18 trillion. So if somehow everyone wanted to, hand in their electronic funds to the central bank and take out paper currency, we're talking about storing $18 trillion worth of paper currency. If the government doesn't want you to store $18 trillion worth of paper currency, it's not that easy. And therefore, there is more leeway, even if you take the dirty approach. If you take the clean approach, no problem at all. Even if you take the dirty approach, I want to argue there's more leeway for lowering interest rates than people think. Thank you.
Thank you very much. Okay, let's move into the fourth speaker, Eric Lonergan, and he is a macro hedge fund manager, an economist, as well as the writer, right? Okay, he is talking about helicopter money. Is that right? Okay, thank you very much.
Thank you very much, and thank you to Gregory for inviting me. There should be some slides coming up in a minute, or at least one slide. I only have to try and get this device to work once. I don't know if it is going to come up. Anyway, there we go, perfect. Hopefully the text, I'm sorry, it's too small to be visible at the back, but it's just a summary of what I'm going to say. So the first thing I would ask you to note is I was asked to come here and talk about helicopter money. There's no mention on my slide of helicopter money because I've realized if you want to do anything in central banking, you have to obfuscate. So if you want to do helicopter money, you definitely don't call it helicopter money. And in fact, what I'm going to argue is that we're already doing helicopter money, just very incompetently. And my recommendation is let's do it competently and let's do it effectively. But that's the last mention I'm going to make of it. We can maybe come back to it in the Q&A. Right, so the first question is, what is the challenge facing monetary policy? And I think it's crystal clear what the challenge facing monetary policy is, which is the impotence of the monetary authorities. And I totally agree with Athanasios that it's, in my view, a moral and intellectual scandal to have central bankers now saying we need help from other parts of the economy, when we all know, if we're honest as economists, we spent the last 30 years saying that central banks should be independent and that inflation is everywhere a monetary phenomenon and that we're entirely able to manage aggregate demand. We can't wait until we fail and then say it's somebody else's responsibility. And I also just simply don't believe it. I don't think it's intellectually honest. Now, I should stress right up front, as we saw earlier, I'm quite optimistic about growth. But we should absolutely not view recovery in our economies as being indicative of the success of our policies, because it's not the outcome, it's how quickly you get to the outcome and at what costs you've borne in the interim. And I would say we've all singularly failed because the recovery's everywhere, bar perhaps China. I would say the Chinese have illustrated cyclical economic success in that their recovery was very, very rapid and immensely powerful. But everywhere else, the recoveries have been very slow. So we can't really pat ourselves on the back just because we've got recoveries. It took us too long. Now, policy shouldn't be based on optimism or hope. Policy has to plan for the worst, and the worst is clearly a recession. So I want us to genuinely pursue the issue of what policies do we think central banks could implement if we were hit by a recession currently. Now, I also want to suggest to you that there has been some profoundly important innovation in monetary policy. And I'd be very interested to know who at the ECB deserves credit for this, because I think that TLTRO is far and away the most important policy innovation since the financial crisis. And that's what I'd really like to argue in the next few minutes. And the reason for that is I think the TLTRO is virtually limitless. And I'll go through why I think that is the case. Or at least, let me put it like this, I think it reduces our problem to one of administration. Right? It potentially solves the administrative problem. So what have the innovations been since the financial crisis? QE, forward guidance, TLTROs, TLTROs, again, it's a fabulous example of making sure that when you do something profoundly radical, you give it an acronym, and your explanation of it is baffling. If anybody actually goes and tries to understand what a TLTRO is, they won't be able to make head nor tail of it. I'll explain it very, very briefly. It is more complicated than this, but this is the principle of a TLTRO. It's lending by the central bank to the real economy, intermediated through the banks. Okay? And that is actually being done by the Bank of England now with the TFS scheme. And in fact, the Bank of Japan may have been the first. The Bank of Japan's been doing some amazing innovation because after Fukushima, the Bank of Japan started to lend to the banks for specific lending purposes. Now, the other profoundly important innovation that's occurred is absolutely the introduction of tiered reserves. But more important than just tiered reserves is the idea that the central bank has more than one interest rate. Right? That is profoundly important. As soon as you recognize that there's more than one interest rate, you realize the power of monetary policy. I'll give you a very simple example to illustrate this, and I think for me, this kind of captures a lot of what Miles, it's interesting to me that Miles is kind of advocating multiple interest rates. But let me give you an example. The Chinese used to, only a decade or so ago, they used to own their commercial banking system. Right? So the commercial banks were part of the state. So the state ran monetary policy. The state set deposit rates and lending rates. So there are effectively two critically important interest rates in the economy. Now, how do you guarantee, if you think of Miles' models, that we're going to stimulate the economy? Well, instead of making a neutral transfer, in other words, changing the deposit and the lending rate by the same amount and then hoping that there's differential marginal propensities to consume and there's no problems with intermediation, let's raise the deposit rate, okay, so that makes a transfer to depositors, and let's cut the lending rate. Right? It's nirvana for everyone. Now, of course, what that means is you run a negative net interest margin within the banking system, which is precisely what the Chinese did. And of course, you can generate whatever level of nominal demand you choose to generate. And that is printing money and distributing it via dual interest rate. So once central banks have started to introduce dual interest rates, they have a monetary bazooka. And the ECB and the Bank of Japan have both done this. So one of the critical arguments I want to make is what's interesting about TLTROs in contrast to QE, although I broadly agree with everything Anathios was saying on this, is that the marginal impact of TLTROs increases dramatically. Whereas the marginal impact of conventional monetary policy, i.e. interest rates, the marginal impact of QE diminishes very rapidly. And I'll hopefully be able to illustrate that. Very briefly as an aside, most of my I think the greatest clarity comes from reading on this entire subject the first 2 pages of Milton Friedman's 1968 AER address. I recommend everybody to reread it. It's famous for its comments on the long-run Phillips curve being vertical. That's not what's interesting anymore. He gives you a 2-paragraph explanation of secular stagnation that's better written than anything Larry Summers has ever produced, right? And it was done in 1968. He also explains very, very clearly when you've got plentiful reserves, there's no point in doing QE. Because what he makes very clear is there's no wealth effect. You're simply substituting one asset for another, right? So QE is very, very simple. If I'm the financial sector, you're taking a bond from me and you're giving me cash. My net assets are unchanged. So Friedman's absolutely clear, when interest rates are zero, when there's huge amounts of liquidity and there's no term premia, there's no point in doing QE. But he says there's a critical difference if you just gave me cash, because my net assets would increase. So he actually believes in the Pigou effect, and he's absolutely correct. We've just all been taught a stupid Pigou effect, which is the idea that if there's deflation, real money balances go up, which stimulates demand. That's not clever Pigou. The clever Pigou, which Friedman actually attributes to Haberler, who, if you're like me, you've never ever read any Haberler, is actually that if you can increase the monetary base, and effectively you don't buy people's assets, but you effectively give the private sector, you make a monetary transfer to the private sector. If you continue to make a monetary transfer to the private sector, you will increase their real monetary balances unless you get inflation or higher nominal demand, which is why actually the Pigou effect is very, very powerful. Now, the first point I want to make, and this is where there's kind of hidden helicopter money, is actually all of these policies, QE, TLTROs, tiered reserves, and I suspect what Miles is suggesting, are actually all of the same thing. They do 2 things. They alter the price of credit, and I don't want to talk about that because I effectively think that game is over, right? The problem is not that interest rates aren't low enough. But the other thing they do is they transfer money printed by the central bank to the private sector. It's as simple as that. Now, take the QE point. I can illustrate, let's say Milton Friedman's in the room, and he says, okay, what you need to do if you want to hit your inflation target in Europe is you want to do a helicopter drop of €1,000 per adult citizen. And I kid you not, it's going to work. And by the way, we've got loads of empirical evidence that it works because it's just a tax rebate. The Americans are geniuses at naming things. If you call something a tax rebate, it's actually an honest, moral high ground because you're giving good citizens back the taxes they pay. If you call it a helicopter drop or something else, people say you're getting money for nothing, right? So naming and framing is everything. So let's I don't know what they are, some kind of European citizens dividend. So Friedman says, don't you worry, we've got all the evidence you need. Look at tax rebates in the States. It affects the economy. The only question is how big the multiplier. Better evidence than QE, better evidence than negative interest rates, better evidence than anything anyone has ever done because we've got lots of studies and we've done it on lots of occasions. But then you say to Milton, sorry, Milton, there's a problem with that. We don't have any helicopters, so we're not sure whether it fits in our mandate. The only thing we can do is QE. That's not a problem. Is that I can give you a helicopter drop with QE. So the way I do it is I say, how much do we want to distribute? I'm going to simplify the numbers here. Let's say we take the Euro stocks. That's the index of European equities. And let's say it's currently got a market cap of 10 trillion euros. I want to do a helicopter drop of €1 trillion. So what I'll do is I'll buy all the equities for 11, and then what I'll do is I'll sell them back to you a day later at 10. So what's happened to you? Okay, now, bear in mind, this is a critical point. This analytical error is made repeatedly by central bankers when they talk about QE. They all say they don't want to make a loss in their balance sheet. The only difference between making an actual loss on your balance sheet and doing QE is the loss on your balance sheet with QE is contingent, right? You are expecting to make a loss if it succeeds. So you have an extraordinary comment by the Deputy Governor of the Bank of England who says, we don't want to have a negative interest rate on our TFS, which is their lending program, because we'd be making a loss. Well, hang on a minute. What was the point of doing QE? If you're buying gilts at 0.5 after Brexit, if it works in any sense, which it has marginally, gilt yields today are higher. So you're willing to make a contingent loss, but you're not willing to make a guaranteed loss. So you could make a certain small loss or a large contingent loss. That's an absolute nonsense, and that's coming from the Deputy Governor of the Bank of England. So the key point I want to make here is all of these policies are actually about transferring money that's been created by the central bank, money that has been printed, to the private sector. The question is, do we want to transfer most of it to Warren Buffett and Bill Gates? Or can we make it a little bit more effective than that? Now, the TLTRO is actually a way to do it more effective than that, and I want to explain. So, the beauty of the TLTRO and the beauty of the evolution of the TLTRO is, so what is the central bank doing here? The central bank is saying, I'm going to lend to you, the banking system, at an interest rate that I've now separated from official interest rates. This is no longer necessarily the deposit rate. This is no longer a money market interest rate. I'm just going to determine this interest rate as I see fit, okay? Which means I could set it at 0, I could set it at -4, and I don't change any of it, so no savers are up in arms. Nobody in Germany is crying wolf and panicking. I'm going to set a separate interest rate on the TLTRO. The other thing I can do is I can extend its maturity, because the maturity has been extended. So I've got a second axis. I could suddenly make a 10-year loan at 0 or a 20-year loan at 0. And then the final thing is I can decide what it's going to be used for, and I can decide how much. Right. Well, to cut a long story short, if you don't think that's powerful, look at the extreme. And this actually isn't even the extreme. The extreme, one extreme is a perpetual loan at 0 interest rates. So I say to the banking system, I'm going to give you €1 trillion of perpetual loans at 0 interest rates, and you have to do all of the hard work for me, which is the only people who are eligible are European adult citizens. And we work out exactly how much that means per capita, and you're going to distribute it through the TLTRO. Now, if there's any advocates here of a thing called basic income, they could even generate basic income if they wanted to, because they could say, you know what, we'll do a perpetual at a negative interest rate, where you get paid a certain amount of money every year. So the key point I want to make here is that we have got grotesque obfuscation going on, right? The reality is the unconventional means interest rates don't really work anymore. We're now going to transfer money to people. We're doing it in a dramatically incompetent way that is confusing to everybody. We should do it in a much clearer, honest and fair way. And we have somebody very, very small, the ECB, has come up with 3 axes which you can just incrementally continue to expand. So there is absolutely no reason why the ECB can't generate nominal demand, can't hit its inflation target, and can't bring European unemployment back to full employment.
Okay, thank you very much. So I move to the last speaker in this session, who is Tokiko Shimizu. She is from Bank of Japan. He is now head of the London office, and she will focus on the potential additional monetary tools that the BOJ could use in the next recession. Okay.
Thank you very much for this, Professor Nakamura. And first of all, I'd like to thank Professor Matsubayashi for inviting me to attend this distinguished conference. My name is Tokiko Shimizu. I am a general manager for the Europe. That's the correct position.
Oh, sorry about that.
And covering the whole Europe and Africa and Russia as well. So I'm living in London. So today I'd like to focus on their expectation. So the unconventional monetary policy is a policy for central bank to try to make a good impact deliberately on the expectation. It is the unconventional policy as I defined. So the first, and I'd like to discuss 3 phenomena related to the expectation. The first one is the inflation expectation in Japan. And the second one is the forward-looking monetary policy conducted by the Bank of Japan. And the third one is the role of expectation in the structure policy. So structure policy is a very, very important factor for conducting the monetary policy these days. So let me start the first expectation story. As you may notice, globally speaking, the 2017 is a very epoch-making year, especially for the central banks. Many of our colleagues in the United States and even in Europe, as usually, already started to discuss about the retreat from the unconventional policy. So, because, as you may be looking at the figure 1, the recent IMF prediction shows the global economy will continue to grow around 3.5% through the 2018. But there is an ancient idiom which saying that the retreat is more difficult than attack. So this is also the case in the monetary policy arena. So how difficult it is, I'd like to explain. In Japan, we also observed expansion of the economy. It is the first time for the Bank of Japan to use the word expanding in the assessment of the economic situation for the 9 years. That means since March 2008, just before the Lehman crisis. And yesterday we have the figure of the Tankan, you may notice. The index shows the almost the first time for the 10 years, it is a very large number of the improvement of the corporate confidence these days. And you may also see in the figure 2 that corporate profit situation as they marked a historical high level for 2 consecutive quarters since the last quarter of the 2016. And under those very favorable circumstances of profits, the corporate investment, fixed investment, is also backing on the track of increasing. And we also observed recovery of the private consumption. It has picked up and so its resilience is increasing lately. And we also observed the unemployment rate already declined to the 3%. That means it is almost a full employment in Japan we achieved. So those, based on those very good signals, we have assessed the economic situation in Japan is almost expanding. And we are very confident that the effectiveness of our monetary policy. But at the same time, we should be patient for taking next action compared to the colleagues in the United States and Europe, because the year-on-year rate changes in the CPI for all items, exclude fresh food and energy, have been hovering around 0% still. So we should be patient in the taking action. So the question some would pose is why the rate of increase in inflation and wages are not so rapidly rising. So some could explain such a puzzle by the structural factor in the labor system in Japan. Someone pointed out this structural factor that there is a different wage setting system in Japan for full-time employees and part-time employees. We already observed the wage increase in the part-time employees. The pace of increase of wages for them are almost in line with what we observed in the past. But on the other hand, the full-time employees' wage increase is so moderate, like 0.5% or 0.2%, so low. The reason why such a low pace of increase in the wages for the full-time employees is both labor and management put their priority in the stability of the employment of wages over the short-term wage increasing. And many of our branch managers across the countries are reported that there is an additional factor to those structural factors that the Japanese firms trying to absorb the increase of labor cost by streamlining their services. Then you can see the increase of labor productivity. The Japanese labor productivity is the lowest among the G7 countries, but the pace of increase in the labor productivity recently is the highest one among the countries. Then we should be patient for taking the next step, because the increase of labor productivity is very good things, of course. we don't say that such increase of labor productivity should be viewed negatively because it implies the rate of increase in inflation will be moderate for a while. So we can even say this is the only way for Japan to keep growing because with the most rapidly aging population. So this is the only way for Japan to keep growing. So that's why we can be patient for taking the next step. And also we can say that there is a difference between Japan and the United States for how the labor productivity increase. In the United States, we have some figures that the inequality at the same time increase with the increase in the labor productivity because some replacement by some information and technology, information and computer technology by the low productivity workers. But in Japan still, we don't observe such a replacement. That means full utilization of the wider range of labor and increasing the labor productivity, both of them we can observe in Japan. Then I'd like to move on to the second story, that is the forward-looking monetary policy. The major part or important part for conducting monetary policy is the controlling of expectation, the forward-looking manner. It is not the words said by ourselves, but you may probably notice Ralph George Hartley, the close friend of the Keynes, he stated those kind of words in his books published in 1923. So he also said that we should counteract against not the historical price movement, but the future price movement. And it is a psychological problem. So then expectation is the most important factor for us in the very unconventional world. The unconventional monetary policy tools can be categorized into the three pillars: quantitative easing, negative interest rates, and yield curve controls. Under the first pillar, as many have mentioned, that the large amount of liquidity we provided into the market, then our balance sheet sizes are very large relative to the economic size. But reason why we needed to provide such a huge money into the market is the existence of zero interest rate boundary, which is also mentioned in many of yours. Then we step into the second pillar, negative interest rate. Actually, we observe this shift of market participants' expectation for the future interest rate. This is the figure we observe in the swaption market. After employment of negative interest rate policy, market participants really expected the possibility of the negative interest rate in the future. Such a shift of expectation is a very good consequence of the monetary policy, we admit. But still, we couldn't achieve the target yet. So then we step for the third pillar, yield curve control. Yield curve control is the more strong policy to control the expectation. Even in the long 10-year interest rate, we try to control. So it's been almost 1 year. Based on the 1 year, we have accumulated tremendous evidences which shows our ability to control the yield curve. We are very confident with controlling the yield curve. The reason why we are so successful to control the yield curve is we succeeded in sharing the expectation with market participants on the optimal shape of the yield curve. Since the last fall, because as the global interest rate go rising, the effectiveness of our yield curve control monetary policy becomes stronger, as you may notice in the figures. The level of the yield curve change of the yield curve are very smaller in Japan because we control the long-term interest rate. But you may remember the taper tantrum. We observed the taper tantrum just after the ex-chairman Mr. Bernanke remarks in 2013. And also we observed a similar tantrum in Europe in June, just after Mr. Draghi's speech in Portugal. So even though we have been successful in control the yield curve and sharing the expectation with market participants, Bank of Japan need to update our communication strategy in as timely a fashion as possible in response to the change in market and economies. Then I'd like to conclude my remarks on the third story, Abenomics, structure policy. You will have heard the three arrows of the Abenomics. Originally, the first arrow was or is the monetary policy. But the most important arrow is the third one, the structure policy, new growth strategy. So then you may notice that the Japanese economic system is one of the most efficient systems in the world. But the reason why we need to reform such an efficient system is we can no longer rely upon the labor force heavily concentrated on the young and mid-aged men. So we need to diversify our labor forces. So I myself, you may notice, the first female general manager for Europe. So it has taken only 140 years for the bank. So in the structure policy, it takes 100 years sometimes because the Japanese efficient economic system lasting 100 years, more than 100 years. So it is we are very patient in this area too. So I myself, of course. And I stop here. Thank you very much. Thank you for your attention.
Okay. Thank you very much. Thank you very much for all of the speakers. Now questions are open for the audience. This time this way, right? It's okay? This way. Okay. Okay.
Much for this. I mean, I thought that the first panel couldn't be improved anymore, but here we have such a plethora of ideas. We've heard about increasing the inflation target. We heard about reducing the interest rate to negative territory. We heard about monetary bazookas and very patient labor force, which could be improved. Thank you all for that. Simply because all the ideas are so concentrated, I'm actually having trouble understanding what are really thought experiments and how much of this is really something that we can, in the era where we're looking for monetary policy change, how much of this can really make a difference. Miles, I thought your idea was really very compelling, if not for any other reason, for the very fact that you're the first one to acknowledge that monetary policy has got distribution effects, and we should think about them. I mean, as somebody who was participating in, Lex, correct me if I'm wrong, writing inflation reports, we've never talked about distribution effects of monetary policy. I think it's high time that we did that. Now, how to do it is, of course, not an easy thing. And I think your idea doesn't come without any flaws. And if I could say anything, you didn't really say anything about the possible risks of going down the route of something that we actually know very little about. I mean, Gregory talked about not understanding sort of QE and the risks of QE. Do we understand the risks of getting down to negative territory at the level of magnitude of 500 percentage basis points? Do we know what that means in reality? And if not, I mean, the multiplicity of interest rates, I think, is an important point. But one of the things that pops into mind when you talk about such policies is really you're politicizing monetary policy. And as a student of conservative central banking, the one thing we wanted to achieve was to depoliticize monetary policy. And by that, I mean on a business cycle frequency. So you need to talk a little bit about this and what would it imply. You don't want to talk about pension funds, but we are an aging society, and if we don't put money aside to sustain payments in the future, that is going to be a huge side effect, repercussion of some of your policies. So it would be important to present a little bit more balanced arguments in this respect. For the sake of just understanding, you're entering a territory that nobody knows, so if you could sort of present the other side would be very educational. And Eric, on the monetary bazooka and the helicopter money, do you have a view on how this would work in Europe, where we have huge debt overhangs? Will this go towards paying back? Because there is evidence, at least on the corporate side, that any free fall that comes in this respect goes back to pay bad debts. It doesn't go back to stimulate the economy. So, would you argue that this is just a transitory phenomenon, or what? Thank you.
Thank you very much. I really liked the debate this morning and afternoon. So let me continue as the conservative, or I would say humble, central banker, because I feel this is a kind of a debate between the humble, responsible central banking community and the more overconfident, and if I would add a moral tone, a little bit irresponsible central banking analysis. Now, this panel, the idea underlying this panel is that we need a lot of innovation and new instruments. We have to think about a lot of new instruments. And it's also about uncertainty, what we know and what we don't know. And what I found very interesting is the presentation by Gregory on the development of interest rates, because there's one area where we have a huge lack of knowledge. There are at least two radically different hypotheses of how to explain the trend decline in interest rates that we have seen entering into the lower bound. On the one hand, you have the hypothesis to be adopted implicitly, perhaps by all panelists and perhaps everybody else here except me, that there is a secular stagnation going on, systematic lack of demand. That's the one theory, and that's the theory I think that underlies a lot of what's going on. But there's a second hypothesis that's systematically too expansionary and asymmetric monetary policy. There is some interesting work of Claudio Borio going along those lines, but it's basically the theory behind this is the Austrian business cycle theory. And that says that systematically too low monetary policy causes boom-bust cycles. So what is the cure according to secular stagnation is the very problem according to that theory. Now, the point is, who's right? It's very difficult, I would say, if not impossible, to decide empirically, because the neutral rates are not observable by definition. So you have to look at it more via an analysis of plausibility, a theoretical analysis, and cannot elaborate here, of course, because I'm already talking too long, perhaps, for a comment. But I would say secular stagnation is an implausible hypothesis. Very briefly, it would almost imply that there is no proper market functioning over very long periods. If that is the case, then I think the first best policy is to do structural reforms. And that's what follows from the second hypothesis anyway. So that would be my comment.
Okay, so I have a comment, perhaps a question on negative interest rates, and I agree with you, Ulrich. I come from a central bank where we also have negative interest rates. It's the Riksbank, the Swedish central bank, and I agree with you that the outcome, the effects have been positive, particularly in combination with QE. But the question here is not one of mildly negative interest rates, it's one of deeply negative interest rates. And Miles, you've worked on different techniques of sort of getting there. And the problem is the existence of cash, I guess. But with or without the existence of cash, I think there's another separate question, and that is that negative interest rates are not popular. Now that may sound like a very irresponsible term, but I think what happens here is that you clash with long-held social conventions. And these social conventions, they permeate all types of contracts that we have in our societies, legislation. We have bankruptcy laws, we have corporate laws, we have taxation. And as you also mentioned, Ulrich, it also underpins much practice in financial markets. I mean, that needs to be studied more. But so I personally, I'm very skeptical of the idea of ever having deeply negative interest rates, in particular having them for a long time, which means that we have to rely on other instruments.
Thank you. Very minor comment on the Gregory, and you're proposing the raising the inflation targeting that. But as you know, that the BOJ adopting that instead of the raising the inflation targeting that last September, they adopted overshooting of the overshooting the commitment of that. I think that it's better to do that. So that what is your view on that comparison with the two?
Thank you. Control? Yeah.
No, I just wanted to understand better how TLTRO is in the end helicopter money. I didn't understand. What's the real link? Why is it comparable to helicopter money? Perhaps you can just explain once again.
Okay, sorry about that.
Yeah, thank you very much. Of course, we have an inventor of a TLTRO on the table, so Ulrich can say something about it. Now, Athanasios always teases me because I defend the ECB, even if I left it 5 years ago. Let me tell you that the TLTRO is a measure I like least of all those that were invented by the ECB. And I guess that this is for the opposite reasons for which Eric likes so much the TLTRO. And the reason I don't like the TLTRO is that, to me, it is reminiscent of my previous life in Italy in the 1970s with direct controls, where the central banks entered into the functioning of the economy, told banks what they had to do. It acted on the credit allocation. I mean, this is the idea of the central bank as universal fixer, which to me is just basically wrong. The central bank is a very specialized institution that can do one thing only and should be limited to that. So maybe I'm echoing something of what the conservative central banker was saying, and I hope I'm not so conservative, but okay.
Okay, so 3 short questions to Gregory, Miles, and Eric. Now, Gregory, I mean, when you discuss the pros and cons for raising the inflation target, somehow I had the impression that you think that it's so easy to reach, let's say, a floor level of 4% inflation. So you say we can rely less on quantitative easing if you raise the target, but if we can't raise the current target, let's say neither in Japan nor in Europe, then how would we raise an even higher target? Now, on my side, I mean, I very much like this idea of a rate between the e-currency and the paper currency. And I believe in your framework, the e-currency would be the legal tender. So all prices in the shops were indicated in e-currency, and if people would use cash, they have to pay a different amount of of cash, face value cash for let's say for a product which worth €1. But my question is that whether the paper currency would not just have a separate life, in a sense that people would believe that okay, negative rates will not last forever. So if I hoard cash, and even though its rates is expected to fall, maybe in 5 years from now it will be over 1. So why not just continue to hoard cash in the belief that negative rates will not last forever? And in this case, I think this trick that the exchange rate between the E and the paper currency has may not work. And for Eric, if I understood you correctly, you want to do helicopter money by using TLTRO, whereby the central bank will tell the banks to which sector to lend at what rate and at what maturity. And one option would be, let's say, to tell the banks to lend to each individual, maybe even a perpetual loan without any maturity, and so something like that. But in order that to work, the individuals will also have to take the loan because certainly banks can offer loan to SMEs or whatever sector the central bank wishes to have, but the SMEs or the individuals will have to take the loan. And how do you convince, let's say, Germans that they should take a loan even if it's a 0 rate and a very long maturity?
Okay.
Thank you. Very briefly I'm going to start in reverse. So for Tokiko, I think it's an excellent presentation of what the BOJ is doing, which I consider textbook perfect. But I would still be interested to know, suppose that we had a 200 basis points increase in sustained inflation a few years before it's anticipated, what would the BOJ do to its current policy? For Gregory, I agree with the considerations of whether we should raise the target, but I think we should simply clarify what it is. For the ECB, for example, I think it's very important to clarify whether 2% is a symmetric target or 1.9% is a symmetric target when core inflation has been around 1% for 5 years on average. I think just getting to the right number should be enough. The other thing I should mention is that 2% wasn't chosen out of nowhere. If you go back 15 years ago, there was a lot of research at central banks, including the Fed, the ECB, the Bank of England, that actually did many of the trade-offs that you were suggesting to reach to a 2% as being a reasonable number, not high enough to deviate from what we understand as price stability, but high enough to give you the leeway on the zero lower bound. For Eric and Miles, I actually like your suggestions a lot, but I'm going to have this rare moment where I will agree more with Francesco on the following idea. Much of what you describe I consider as fiscal policy. And monetary policy has tremendous fiscal implications, but as Maria was pointing out, if we want to keep independence in central banks, then we should try to separate as much monetary and fiscal, which is why I have been arguing buy as many government bonds as necessary, and unlimited QE means as necessary. For the ECB, I think a couple trillion more would do it, and then you wouldn't have to do any more. And then the treasuries can actually do the redistributional elements that are associated with subsidizing banking loans on one side, for example, subsidizing deposits so that the low-income individuals are not hurt on the other side. All of these things, I think, should be done by the treasuries. On TLTROs, I should point out, I think it was a wonderful innovation, but it is primarily fiscal, and it doesn't work the same way everywhere. You need to have well-capitalized banking system to do this. So the TLTROs would actually work better in those areas where the banks already have the capital and can take advantage of them. So you still have these distributional issues that are quite tricky to deal with. Then finally, for Ulrich, one thing you mentioned I would question. You mentioned that there is an issue with moral hazard that has to be taken by account by central banks. And you mentioned that in your view, the trade-off associated with moral hazard was gotten roughly right. There is one specific element where I would like you to comment on. I think in lender of last resort operations to banking, I think I would agree with you. the moral hazard issue was taken about right. When it comes to governments, however, I question whether it's even appropriate for a central bank to mention moral hazard on the behavior of the governments as a factor for adjusting monetary policy. I think this is deeply illegitimate and undemocratic, and the question to you is how you would comment on Ottmar Issing's statement from 2005. I will read it to you. It is not and cannot be the ECB's role to enforce fiscal discipline and to correct shortcomings in the implementation of the Stability and Growth Pact. Attempting to do so would politicize the ECB's operations and ultimately threaten its independence. I agree with Ottmar on this one. I wonder if you do as well.
Okay, thank you very much for the questions. I'm sorry, but I can give each panelist Japanese 4 minutes, which is 240 seconds. Okay, okay, ladies first. Okay, all the ladies first, please.
Thank you very much. I think I have only one question from the Professor Ofandis. So, of course, we admit we missed the target when we declare that we can do that in 2 years. But at this moment, as I said, what happens in Japan is the increasing of the labor productivity. That's the reason why we need to be patient for that achievement of our target. In that context, we cannot say that we need to keep that target achieving within 2 years or something, because we need to promote such an increase in the labor productivity. In that context, we need to be patient. But we are very convinced that if such an improvement in the labor productivity continues in the future, probably the firms will shift their behavior to pass on such a labor cost increase to the prices. In that day, the expectation of inflation will also increase accordingly. So we need to wait for that moment. I cannot say when is that happen, but probably that there is a natural limit to increase the labor productivity. They cannot continue forever to increase the labor productivity. In that context, we can be patient for a while. Thank you very much.
Well, the first thing is very clear. I need to go on a diplomacy course. Because the first point I would make with all of the questions is you're not comparing the policy proposal to existing policies. So on all of the observations you make, I would say the ECB has already grotesquely breached those standards. So if you say, what has happened to the ECB's independence through the euro crisis? Well, chronic damage has been done to the ECB's independence. We have the ECB intervening in political elections. I mean, they intervened in the Italian election. They arguably virtually publicly expressed a desire for a change of a national leader. In Ireland, on a side of A4 paper, they described what was to be done to the Irish economy. Where is that in any treaty? The ECB within Germany, in terms of negative interest rates, to me, are a disastrous idea. They are a huge experiment. They are hugely unpopular. So the politicization, independence, funnily enough, the proposal that I'm making would be deeply popular, right? It is possibly the only monetary policy proposal where European citizens would go, actually, this European enterprise might just be working in my favor for once. Now, as to the empirical evidence, so first of all, is it irresponsible? You see, we've had a lot of major irresponsibility so far because we have deep antipathy towards the European project because of the euro crisis and because of the slow recovery. We have an observation that technocrats, unelected, Mario Draghi is the most powerful person in Europe. He determines the fate of nations. Right? That is dramatically undermining the political legitimacy of what we're doing. So now, is it irresponsible? Let's measure that on two standards I would give you. How much balance sheet would be required? So the financial risk of what I'm suggesting. And how much empirical evidence do we have that it works?
Right? We have vast amounts of empirical evidence because all I'm describing is a transfer. We have loads of economic evidence. We don't need to worry about, we have all, you look at American tax rebates. People who are leveraged, yes, they do. People with low incomes, living hand to mouth, they spend more. People on high incomes save. We know this, and we know the range of the multiplier. We know nothing about negative interest rates. We know very little about QE, all of these other monetary experiments. The balance sheet that I'm talking about, if you use standard fiscal multipliers, you're talking about 3 to 5% of your balance sheet. The only difference is I'm being transparent. So what I'm suggesting is the central bank is going to lose, in inverted commas, for whatever that means, 3 to 5% of its balance sheet. What everybody else is proposing is we're going to hide those losses. So we have backdoor fiscal monetization. See, I hate to say it because I'm pro-European. I think the OMT looks illegal. I think it's very debatable whether QE. I think the SMP program, those are highly debatable. However, if I say central banks throughout history have made loans to the banking system, and what we're going to do is we're going to do a loan to the banks that's going to be an equal distribution at 0 interest rates as a perpetual to all European citizens. That is, I've got no governments involved. I don't have any conversations with anybody. I'm certainly not parts of troikas telling people what to do. And do you know what? The Germans, interestingly, will be the biggest financial beneficiary by amount. I doubt, I suspect all of the Germans will take it up, and if any Germans don't, they should just go on a basic financial literacy course, because it's a pretty good deal.
Okay, how do you convince them to go to that course?
They'll take it up.
Okay, so there are many questions. I think I'll take Lex's questions that was not only addressed to me, but I think I'll take it. In fact, I mentioned also that I think, okay, we don't know yet if there is secular stagnation or not. I think we only see the symptoms, and it might be true that it's too early to settle the debate. So I said that's a possibility, and in fact, estimation of neutral rates might change dramatically over the next few years, and they might go up. But I still think that, yeah, we see a lot of the symptoms that are a bit structural. The demographics, the low productivity, the reliance on exports, all of this. I agree that they seem structural, but in that, and maybe structural reform would help. But that's not the topic of today. I think, yes, structural reform could help. I totally agree. But I was taking that as a given that maybe we won't have the structural reforms. And since we don't have structural reforms, what can monetary policy do? I think that's what the ECB should ask itself. The ECB should do. In fact, they mention structural reforms in every press conference. But I don't think that's their role to prescribe structural reforms. We should all hope for structural reforms. But in the meantime, the ECB should adopt its monetary policy framework to a lower neutral rate. So that's my point. I think both are complementary. Government should do structural reforms, and the ECB, while they're waiting for structural reform, should do something in order to facilitate the conduct of monetary policy. So that's my view. On Jolt's point, I think that's a good point. That yeah, we cannot reach 2%. So how can we reach 4%? But I don't buy this. In fact, it's a bit counterintuitive. But I think, on the contrary, having a higher target could help, because in fact, given that you would not be constrained you would be constrained much less by the zero lower bound. If it works, then you'll be constrained much less than usual. You will arrive to the zero lower bound less often. So in that case, you will be able to reach your target more often. So it will become more credible. You know what I mean? It might be a bit counterintuitive, but I think if you're less now with 2%, you're constrained often because you only have 200 basis points. If you have 400 basis points, you will be constrained less often. You will have you will use less unconventional monetary policies that are uncertain. And in the end, in the medium term, having a higher target might be more credible. So that's my point. I don't know if I reply to your question. And just on Professor Arfanides' point, it's funny because I was discussing the other day with Maria an article about the origin of it was an article from the New York Times on the origin of the 2%. In fact, you're right that there are millions of papers nowadays that justify the 2%, but originally it comes from a TV show in New Zealand where the finance minister, he said, okay, we should have price stability. That's where inflation targeting was created. calculated. And the guy asked him what should be the target. He said, oh, I don't know, something a bit more than 2%. And then 2% was the number. It worked very well in New Zealand, so it was exported to Canada, then to the UK, and then everywhere. So the origin of the 2% is a bit dubious. I think we have good ways to justify it for today, but maybe we could also justify 4% with the same argument. So I don't think the 2% is sacrosanct. Yeah, I think so. Was there other question? No, I don't think. Thank you.
Okay, thank you very much. Okay, Rick, please.
So, I think you're last. It's in row. Oh, so I'm assuming reverse order of the talks. So Maria Demertis asked about the risks of negative rates, and here it's partly a matter of the courage of our convictions. We've told, those of us who are academics have told students, I'm sure many of the rest of you have said to people, it's the real rate that matters. So if we believe it's the real rate that matters, we have lots of experience with negative real rates. And I think that's particularly true that it's just the real rate that matters if you take care of the bank profits problem and the paper currency problem. What else is left? You could have Y2K type problems, you could have institutional problems, but we've kind of seen that these institutions adjust, people figure out how to deal with the lower rates. You could have some behavioral economics or non-standard effects, but here there's a big difference from QE. It's like QE, it's all behavioral or non-standard kind of institutional things. Here, with negative rates, it's like, okay, it's a low real rate. We understand that in theory, and then maybe there are some extra non-standard things. But I think very importantly, the way it'll actually happen in the world is very gradually. When we talk about what's really going to happen, all I'm saying is, look, if you've done minus 0.75%, you can try minus 1%, and you're probably fine. And especially if you do the minus 5 basis points on the paper currency interest rate, people will see that you have that tool. Because you have that tool, you can definitely go safely to minus 1%. You know, you might have to go to minus 25 basis points with the paper currency interest rate, but you can see whether that's true. So you can feel your way down, and that's the way it'll really happen. So, I mean, once we get comfortable with this, we might go very quickly to minus 4% when we get a serious recession, but that's not how it's going to happen to begin with. It'll be inch by inch by inch by inch. I'm just saying minus 0.75% is not the limit. You feel your way down, you make sure as quickly as you can, when probably won't happen until the next crisis, you try at least minus 5 basis points on the paper currency interest rate so the market knows you have that tool, which gives you a lot of extra credibility. Athanasios Orphanides was saying, not quite doing these questions in order. I want to differentiate myself a little bit from what Eric is saying. I want to be as modest as possible in anything fiscal. And in fact, I want to minimize the extent to which we need countercyclical fiscal policy at all because we have effective monetary policy. However, I do assume that we have a dysfunctional fiscal authority and that you typically can't get legislation through to deal with your macroeconomic crisis. So I want to keep what the central bank does in the fiscal domain extremely modest and mainly focused on solving the central bank's own problems. It's political problems. I don't think it's a ton of money to help solve the political problem of the negative deposit rates. I mean, the banks will do some of that out of their own profits, and then I think it's and solving the bank profits problem. Now, Eric said a lot of things that are way beyond what I would agree with. However, Eric and I totally agree that the bank profits problem is an easy technical problem. If you're willing to allow that much of a fiscal something, central banks can and do solve the bank profits problem. This is current policy to solve the bank profits problem by using some seigniorage to transfer to the banks. And I think that's actually a wise thing. And yes, it's not a pure
Miles, why is that fiscal?
I'm taking Athanasios's label and not disagreeing with it. Finally, I want to come back to, well, not finally, I've got Marianne and Zolt, I'll try to be quick. I totally agree that the political problem is the big one. I think there are a lot of things that need to be done. I've written a children's story about negative rates. I mean, I think we need to do more of that kind of thing to make this seem less toxic. But I want to claim that the alternative to mildly low rates for a long time is deeply negative rates for a short time. That's not how it'll be at the first. First time you do it, you'll be feeling your way down inch by inch. But ultimately, it's like, sure, everybody complains about the negative rates, but I don't see any reason why we can't get back to the natural level of output in 18 months if we go deep enough with negative rates. There's no reason it would drag on long. It's very powerful stuff. Go to -7% if it takes that to get back to where you want to go in 18 months. And yes, some people will holler and scream, but it'll be done in 18 months. It won't drag on and on. I really believe that, and part of the reason I believe that is because there are these redistributional effects where you're taking money from lenders to borrowers, and I think Eric is wrong to be skeptical of the idea that borrowers have a higher MPC than lenders. That way, it's not a fiscal transfer. I think redistributions are a powerful part of the way monetary policy works. It's great, however much comes from the substitution effect, but I think in fact a fair bit of it comes from redistribution from lenders to borrowers. And by the way, that's part of your political problem, is the lenders scream, you've got to talk more about how the borrowers are benefiting than anybody does. Talk about noble borrowers. We've got these stories about the noble people saving. What about the noble borrowers who are going to go to college or whatever? Finally, Zolt was...
This is not understood in this part.
So you got to tell the stories. You got to find the noble borrowers and tell their personal stories. Yeah. Anyway, Zolt talked about legal tender. It's actually not. Technically, it's not legal tender that's the issue. It's unit of account and unit of price setting. And things don't have to be perfect, but you do need some prices to be set in the electronic euro for it to work. And I want to say, finally, there's this question about what about people still saying, oh, cash is going to come back. Why did I store a lot of cash? You do need an extra type of commitment with the kind of policy I'm talking about, which is to never have the paper currency interest rate more than a few basis points above the target rate. Okay, so that is an extra commitment you need to have. Now, to the extent you're worried that, yes, you have this commitment, but people might worry that somebody else would come into power who would do otherwise, then you have to have a low enough paper currency interest rate conditional on you continuing in charge to make up for the fact that maybe somebody else would have a higher paper currency interest rate. But it's just a typical kind of central bank commitment problem. You just say, the simple way to do it is at the initiation of the policy, you say, look, our paper currency interest rate of return on paper currency will always be equal to our target rate plus or minus a few basis points. You set the spread, you stick with that spread forever, except when it would take paper currency above par. People will get used to that pretty soon. And if you blow your credibility on that, then you can go to a floating rate like Marvin Goodfriend talks about. But I don't see any reason why saying paper currency rate, it'll always be equal to the target rate unless that would take paper above par. People would get used to that fast.
So, I mean, let me start with the TLTRO, as Eric mentioned it. I mean, Eric, you said at the beginning, helicopter money is your topic, in fact, and you wouldn't use the word further then. And you somehow associate TLTRO to helicopter money, but I think that's just fundamentally wrong. You should have just talked about helicopter money explicitly. TLTRO is, to recall the details, it's a 4-year credit where you can get the credit at as low as minus 40 basis points, which is a negative lending rate. I think it's the first time a central bank has given negative credit at a negative rate, and it is at the same time a 4-year credit. So this combination, of course, was quite strong and innovative. But it's not. I mean, it's not a subsidy in the sense that risk-free capital market rates stand below that level those days. No, it's not a present. It's a rate. I mean, if you go into negative territory, a central bank can also lend at negative rates. Yeah. So the deposit for the TLTRO is that. Yeah. It's not a lending at rates below, let's say, risk-free market rates necessarily. Yeah. Of course, it's a 4-year credit, so it is very cheap, and therefore it was limited. And there's a formula, indeed, of limiting recourse depending on what you do in terms of giving credit to non-financial companies.
You got your fingers crossed.
Sorry?
No, I'm only kidding.
And I mean, decomposing it, I mean, what was the innovation? So you could say it's a negative rate. It's also, that was the innovation. The rest, I think, is not an innovation. That central banks have associated cheap credit to lending is, as Francesco maybe reminded also, is old. And if anything, you know, central banks got rid of it. Example, Bundesbank gave for decades, what was called a Rediskontkredit at a low rate, so at a lower, at a limited quantity, at a low subsidized rate, against trade bills. No, it was associated to a certain type of collateral, which you can say is a good thing because it's the real economy at work. So I would say that is not new, and the idea to, I mean, incentivize, associate the rate to the amount of lending is also not new. It was, as someone mentioned, invented more by the Bank of Japan and the Bank of England, so we don't deserve credit for this. And in terms of overall merits, I think the mix, it's again the mix, I mean, Miles is a radical negative rate. Athanasios emphasized QE. You think TLTRO is everything. At the end, probably every non-conventional measure has marginal costs of distortion somehow, yeah. And I think the TLTRO may be similar to, you know, buying all sorts of assets at a certain time. You know, you just the principle of a decentralized market economy is somehow weakened. But I would say the mix between the measures gives enough firepower to central banks, even in a lower growth environment. And there, on what Lex has been saying, of course, structural reforms are right. It would be nice if we would be in a world with higher growth rates. But that's not we can only say it, it's not our job. And a conservative central banker should not conclude from that to do nothing, but he should conclude that he should still do his job and use the appropriate tools. And then to answer to Athanasios on the question what I think of Ottmar Issing's statement, and of course the statement is right, it's not the central bank's job to exert pressure on fiscal policies in a way through its instruments, absolutely not. Of course, and you said earlier, you said that QE, who benefits from QE, and you were showing 10-year German yields and 10-year Italian yields. I mean, two weeks ago I was at a conference in Munich in Bavaria, and there, of course, I'm always being told, you know, that QE is for the periphery only and they benefit, and it's only a kind of tool to help them. And what I answer to them, no, it's not true. It's a balanced approach. Weighting, yeah, there's a weighting issue, of course. Yeah, if you ask, I mean, we don't buy Greek government bonds, yeah. So you could say, is that a policy measure? I would say this is. I would view that as a measure. General central banks now have in their operations rating thresholds, no, and so here that was the idea, no, that you have a rating threshold. You have to put it somewhere, and it may also apply to governments, no. And here it was put at a certain level, and therefore we don't buy Greek government bonds at the moment. But that's, I would say, not motivated by educational, you know, ambitions, but it's motivated by, you know, I would say, central bank policies on what credit quality they want to hold as assets. Thank you.
Yes, thank you very much. I would like to thank all the panelists. Thank you very much.